The delisting risk is not a concern for me, other than the fact that it just creates short-term volatility to add to the position as people panic. And what we know, Marcel, is that things never revert back to their average. They overshoot on the downside due to emotion and despondency, and they overshoot to the upside based on euphoria. People, for some reason, it's perceived risk. People think they're riskier when they're lower and less riskier when the prices are higher, and they want to buy what's up, and that's when we'll help them out a year, 2 years, 3 years from now, when they're up 100, 150%, and everyone wants them, we'll help them out. Now that no one wants them, we're building our inventory, and when everyone wants it, we'll sell the inventory at high prices. The shutdowns are alleviated in coming months, as they were 2+ years ago, and as they will maybe 2 weeks from now, 2 months from now. We don't know the answer to that question. That Ferrari is going to absolutely fly. And the difference between the Ferrari now and before the lockdowns is while they've been waiting, they added some nitrous oxide fuel. So this thing is not only going to be able to do 180 on the Autobahn, it's going to be able to do 220, 230 and blow by the Bugatti.
All right, Tom, it's great to have you on the channel. Today, I want to talk with you about a couple of topics. First of all, your views on the macros, and well, currently the stock markets are selling off pretty big, right? And then second, also some calls that you are making about where you would actually allocate your money. But first of all, tell us who you are and what you are doing.
Yeah, well, thanks for having me on, Marcel. My name is Tom Hayes. I do two things. First off, I manage money, long short equity for accredited investors and qualified institutions through Great Hill Capital. I make a lot of TV appearances, Fox Business, CNBC, Bloomberg, etc. So I'm a regular commentator with that. And then I have a website called hedgefundtips.com, which is kind of my blog where I post research for free. And we do a weekly video cast and podcast that is now ranked #2 in the hedge fund category by FeedSpot. For podcasts, people are finding that extremely valuable. It has a huge following among the financial journalist community, the hedge fund community, and the institutional investor community and ultra high net worth community. So we're very happy with that. We've been doing that about a couple of years. We enjoy it quite a bit. My clients sometimes call me and say, "Why are you sharing all your secrets?" But I think what I found, the more you share, it goes bigger and bigger, and what you keep to yourself subsides. So we're very happy to do that.
Sounds great. What's the typical client size that you have?
Yeah, based on how we're set up right now, our minimum is 5 million US plus towards the end of the year, because we've been getting quite a few inquiries, but 5 million is a large check for many ultra high net worth investors, and we want to make it more available across our viewership.
Sounds great. Tom, you caught my attention because in a world where yesterday we had a huge sell-off, today VIX is spiking again, and so the stock markets seem to be really doing not so well, and the sentiment is very, very bearish. But maybe you can give us your views right now about the hot topic of inflation and the macros in general and the stock markets.
Yeah, well, sentiment is completely washed out. You know, there was a lot of low expectations coming into earnings, very low expectations coming into the Fed meeting. You saw an immediate knee-jerk bounce, 1,000 points on the Dow or 950 points on the Dow following the Fed meeting once Chair Powell took 75 basis points off the table. And then the next day, it completely collapsed. So it basically messed up positioning two ways. Number one, people were overly short into the meeting, so they got their faces ripped off on a short covering rally. They had to buy. And then everyone started chasing up after the 950 point move on the Dow. They started chasing up, and then they opened the trap door the next day. So I think what you're seeing here is sentiment is thoroughly washed out. Today, what you're seeing is basically they're taking out any leftover stop losses that they didn't hit yesterday. You'll get your residual margin calls. But every indicator I look at, and I went through, as you saw, 30 or so on my video cast this week, they're all at points where you want to be a buyer versus a seller. And I shared with my friend, we were talking yesterday, that our business is all about probabilities. You can be dealt pocket aces in Texas Hold'em and still lose, but if you're not betting pocket aces over time, you're not going to win. And right now, I think based on where sentiment is set up relative to the underlying fundamentals. We've been dealt pocket aces if we're net buyers at these levels. And over time, if you're buying in these periods of dislocation and complete washed out sentiment while the fundamentals are still holding up, you're going to win over time. And we're being selective, but we're being aggressive where we can, because these situations don't come up very often.
Yeah, well, the bears would argue that the sentiment is bad for a reason, because of course the Fed is going to tighten. But what is your view on tightening, first of all, but also inflation in general?
Yeah, well, the facts don't bear it out. So the last tightening cycle from 2016 to 2018, we saw phenomenal performance in some of the areas that people would say would be hit the hardest. We had a rising and strong dollar. We had aggressively rising Fed funds rate from 0 to 250 basis points over that period. And what did you see? You saw China Tech had one of its biggest rallies in history. You saw biotech had one of its biggest rallies in history. And if you ask anyone why they're not invested in China tech or biotech at these depressed levels, two of the things they'll say is, well, you're going into a rising rate environment. Emerging markets can't work. The strong dollar is killing emerging markets. It will never work. And tightening policy is horrible for anything tech related or anything that's not earning money. And I try to burden myself with the facts before I put money to work. Those are common consensus, but they just simply don't bear out when you look at the data. So we happen to be pretty sanguine on that front. As it relates to inflation, I think we're nearing peak inflation if we're not already there. And the reason I say that is not because I'm guessing or I'm hoping about supply chains or this and that. I look at the commitments of traders reports every single week across the broad spectrum of futures, from currencies to indices to grains to energy. And what I'm seeing by and large across the board is the commercial hedgers, which are the big money, have been aggressively short across the grain complex in recent weeks. They tend to be early and they tend to be right. So I don't know if the grains and energy go up another 10 or 15% before the trapdoor opens and they collapse. But I'm not willing to pick up quarters in front of the steamroller. The last few nickels, it's certainly not worth it. I think a lot of this move is played out. You saw it in wages today, came in slightly less than expected. So all in all, I think the panicked frenzy that inflation is never going to end might be overblown. Yes, you've got the war still occurring. Yes, you have these sporadic shutdowns. But when you look at the cases, the COVID cases in China, they're rolling over exactly like they did just over 2 years ago. You've just gone through your first parabolic peak, then a dip, then your second parabolic peak, then the rollover. We're in that final rollover phase. If you look at the data and the charts as it relates to new COVID cases in China, which will alleviate the supply chain, which will take some pressure off of inflation and move us forward.
So you're basically saying at this point, you want to be a buyer instead of a seller, which of course seems counterintuitive given like how much risk there is and how bearish the sentiment is currently. But you also said something which I found really interesting, that the real risk and the perceived risk, there's a difference between that, right?
Well, you hit the nail on the head. I was just going to go into that, Marcel. You're a good listener. Yeah, I mean, the common perception is that the lower prices go, the more risk is in the more risk there is. And it's actually the opposite. The lower prices go, the more risk has been taken out of the price. And that's where you want to step in. And look, we're not buying general indices, ETFs. We're buying individual companies and sectors we think are dislocated beyond any level of rationality and purely based on the emotion. In the short term, the market is a voting machine based on emotion and mania, as Ben Graham said, and in the long term, it's a weighing machine based on fundamentals. So we're taking the bet against the short-term emotionalism, and we're betting on the long-term fundamentals will come into play, whether that's 6 months out, 12 months out, 24 months out, or 36 months out. It's immaterial because the CAGR on the investments that we're leaning into is going to be so material, whether it takes us 1 year or 3 years. We're still looking at CAGRs that'll beat the S&P by 20, 30, 40% per year. once they start to turn. So we're pretty comfortable. And as people say, I get reporters, are you still invested in Alibaba, et cetera, et cetera. I said, yeah, we added some more this week. And they said, wow, aren't you scared about XYZ, blah, blah, blah. And we can go into some of that granularity as you see fit. But no, I'm buying one of the highest quality businesses in the world at a period where it's temporarily impaired due to exogenous events. One of those events comes around every 100 years. It's called a pandemic. The other event comes around every 3 to 5 years in China. It's called communism. And they like to do their crackdowns every 3 to 5 years. This is their latest iteration, a little bit more virulent than normal, but it will subside. Why do we know that? Because at the end of the day, if they continue to press and you continue to see these big tech companies lay off 20% of their workforce, you have the smartest, most capable people out on the street, angry and hungry. It doesn't bode well for their stronghold on power.
I mean, it's maybe one of the most irrational setups if you're looking at the actual valuations of these companies right now. But of course, there are plenty of reasons for it, right? And it's very emotional and additionally now also political on top of that. But at the same time, like the Crane shares, KWeb is washed out by minus 80%, Alibaba likewise. And so it's interesting that you are looking at this one. Isn't there a huge issue like with the additional overhang that you have in investing in China, like with, for example, Evergrande, you have now the COVID lockdowns and also China, Russia, US relations. Do you think, despite those really huge reasons, there can actually be a case made that you have just proposed in saying like, well, there will be a rebound in this stocks?
Yeah, here's how I think about it, Marcel. Let's say you have a rental property that you rent out to tenants. Let's call it a single family home. It's worth $500,000. And you rent that out every single month for $4,000 a month. But something's happened in the last 3 months where you've had no tenants, you've had no income, you've had a vacancy, you're no longer getting that $4,000 a month, but the fair market value of the house is worth about $500,000. Would you immediately accept the first bid for that rental property for $300,000 just because you've had no income for the last 3 months? Or would you have an expectation that even if it takes a few more months, looking a year out, that $4,000 a month will be back, maybe it'll be $4,200 a month, and kind of do everything you could to hold on to that $500,000 property. And what you're seeing right now is you have a temporary impairment of earnings power of the big franchises, Alibaba, Tencent, JD, et cetera, due to exogenous events. As I said, once is 1 in 100 years, once every 3 to 5 years, like clockwork. The Chinese government cracks down. They realize that they've overshot. Too many people are unemployed. They quickly reverse course and aggressively pump the stimulus. And they've been pumping stimulus into the economy aggressively since November, both on the fiscal front and on the loosening monetary policy. The reason it hasn't shown up is because it's very hard to get the impact of the economy when you're shutting down the major city. Like we saw in Shanghai, it's starting to alleviate. There's fears in Beijing. So what effectively you have is you have a Ferrari that's sitting in park. You've got 1 foot floored on the gasoline, so it's making a lot of noise. You've got another foot firmly affixed to the brake at the same exact time. So the car is kind of overheating, it's smoking, it wants to go. It's just waiting for that foot to come off the brake. And once those shutdowns are alleviated in coming months, as they were 2+ years ago, and as they will maybe 2 weeks from now, 2 months from now, we don't know the answer to that question, that Ferrari is going to absolutely fly. And the difference between the Ferrari now and before the lockdowns is while they've been waiting, they added some nitrous oxide fuel. So this thing is not only going to be able to do 180 on the Autobahn, it's going to be able to do 220, 230 and blow by the Bugatti, who thought he had the race won. So that's how we think about this, and we're pretty optimistic about the outlook.
Sounds good, and that's mostly the economic side. So, aren't you afraid that, for example, Chinese stocks could get delisted, or you maybe even barred from investing in China as a U.S. investor?
Yeah, so there are a couple of things. Number one is the U.S. officials are actually in China today discussing a workaround for the PCAOB. the accounting standards so that companies can remain listed in the US. We own our shares in Hong Kong on 9988. We own our options on the US on BABA. The shares are fungible, so you can swap them out for Hong Kong shares for a nominal fee with your brokerage. And you could switch them back, which we'll probably wind up doing once this thing is resolved. So the delisting risk is not a concern for me, other than the fact that it just creates short-term volatility to add to the position as people panic about that issue. I think China needs the US as much as the US needs China, and I think they figured that out in recent months. And I think you're going to see a resolution to that problem. That's really a non-issue. The thing that I think about when I think about Alibaba, though, is I think about Microsoft. It's a company that from 2006 to 2013, a period of 7 years, it dramatically improved the underlying fundamentals of the business under Steve Ballmer. And over that period, the revenues were up 112%, the cash flow was up 193% per share, and the earnings were up 120% per share. And yet, after the 7-year period, despite those increases in fundamentals, the stock did nothing. You could buy it in 2013 at the same prices as you could buy it in 2006. That's the bad news. The good news is over the next 7 years, the stock was up 1,500%, despite the fact that the fundamentals didn't improve as much as they did over the previous 7-year period under Steve Ballmer. And I think we're dealing with a similar situation with Alibaba. Over the last 7 years, from the IPO to the end of 2021, revenues were up almost 900%. Cash flow per share was up almost 600%, and earnings per share were up about 600%. And yet, you can still buy the company right now at 2014 prices. And we think that these type of opportunities to buy such a high quality franchise at such a discounted price come around maybe once or twice in an investing career, and we want to take advantage of that.
Mm-hmm. Would you also buy a basket, for example, let's say KWeb, or let's say make a distinction between non-profitable tech baskets, which you also mentioned, like let's say the ARK Invest funds? What differences do you see there? And maybe also making the link here to your tech on biotech, your call on biotech, which is also quite interesting, and how these three are kind of different in itself.
I would say, I just want to add one more thing on China that I didn't actually quite address. People look at these regulatory crackdowns and they say, wow, this is going to permanently impair their earnings power. They'll never be able to return back to trend. And the way that I think about it is there's an unintended consequence of all government regulation. And the unintended consequence that the CCP has no idea that they've just actually done is the fact that they've made it impossible for small competitors to Alibaba and JD and Tencent to ever flourish. As a matter of fact, most of them are now going to go out of business. So when we get through this temporary impairment that we discussed, where the single family home has been unrented for 3 months, when we get through it and back to trend, what's going to happen is these big players are going to actually get bigger, because the increased regulation creates a bigger moat and keeps out competitors. So what we're going to see 12 months out is Alibaba's actually picked up share, not only in the e-tailing business, but in the cloud computing business, and internationally, they're going to continue to grow 400 million users outside of China. So we like this situation. We actually embrace the regulation, because all regulation does is make the big bigger over time. And now the government has done an about face, because they realized they were all laying off 20% of their employees. And you saw that now they're going to support tech platforms. There's a big meeting happening over this weekend. They're going to lay out all the reasons why and how they're going to support these, because if they don't, the capital flight's going to continue and their power is going to be reversed. And for those who think, oh, I wish Xi would get out of power, look, there are 100 families in China that control all the power of China. Xi can get reelected as many times as he wants, but if he doesn't produce, they're going to remove him one way or another, whether it's 4 months from now, 12 months from now, 18 months from now. And I think he got that message very quickly and very clearly in the last 4 to 6 weeks. He's still standing pat on COVID-0 because he had success with that 2 years ago. So he thinks he's going to have success with it again. He may very well do that. The cases seem to imply that he's going to get away with it one more time. But he's threading the needle. You know, when you think about the China National Congress, which happens every 5 years, on average, the market tanks 24 months, T minus 24 to T minus 12, because the CCP asserts their authority. They crack down on businesses to say communism is strong, businesses are secondary. Then 12 months ahead of the transition, they realize, wait a second, we have an election coming up. Like every politician, whether they're in China, whether they're in Chandigarh, or they're in Sheboygan, their number one job is to get reelected. And then they juice the economy. They pump it with stimulus. They pump it with, they ease monetary policy. On average, the MSCI China is up 31% in the 12 months leading into the China National Congress. So once they get these lockdowns open, they've got a lot of catch up to do ahead of November so they can have a smooth transition. And I think we're going to see things go parabolic to the upside, just as they've been devolving to the downside and got everyone up in arms and nervous.
Yeah, speaking of pent-up demand, you also had a great view on the BYD results. Can you elaborate on that? And do you have some views on the EV sector in general?
Look, we're playing the EV sector a different way through a US auto parts supplier that actually has a lot of major Chinese, the top two Chinese EV producers. I can't speak explicitly about them because we're still building a position and it's now a very small market cap, but they have ample liquidity to get through the supply chain crunch. And that could be a very strong multi-bagger. Maybe we'll be able to talk about it in future conversations. But, you know, BYD's sales were up 180% in the first quarter, while everyone else is struggling with supply chain. So there are a few EV producers like Tesla, like BYD, that have been able to control their supply chain and benefit from the unyielding pent-up demand that has been created by COVID that will not subside, even in the case of a shallow recession in US next year or a slowdown in China due to the lockdowns. It's unparalleled, the pent-up demand, and it's going to be a huge driver. So most of the companies have not been able to control their supply chains and they're losing sales. A few companies have been able to. But I do think that the investment has been made, and what is a shortage of chips now will be a glut of chips in 2 or 3 years. And that's just the way the cycle goes. And car companies, and particularly auto parts suppliers that have exposure to the ICEs, the internal combustion engines, as well as the EV growth, are going to mint money. And right now they're trading like Great Depression levels. I mean, some of these auto suppliers in the US are trading at levels not seen since the 9/11 recession in 2001 to 2003. And if you are a student of Charlie Munger, you know he picked up Tenneco on the cheap. He turned 10 million into 80 million, and then he gave that 80 million to Li Lu to invest in Chinese stocks and turned it into $500 million. 2 chess moves, not a bad upside. So we're hopeful we can replicate some of that thought process and success with some of the U.S. auto suppliers that have decent enough balance sheets to live through, you know, a year, 2 years, however long it takes to get the chips back online.
Let's come back to my question regarding how you make those picks. And once again, you're looking at the balance sheet, cash flows, earnings, pretty much focused on that. So that's why you pick Alibaba as a great investment and this supplier. And so in general, you also mentioned you are bullish on the biotech sector, which seems to be a little bit counterintuitive in this regard and has also sold off by quite a bit, and not so bullish actually on non-profitable tech. Can you elaborate on that?
Yeah, it's a catch-22 because biotech on balance is a non-earning basket, but they have, why it differs from non-earning tech is there's no catalyst for Zoom or Peloton or any of these Teladoc that have just been slaughtered. There's no catalyst that their revenues are going to go up 10x in the next 12 months. And what you're basically doing when you buy biotech in a basket, because you know to pick individual discrete names like I'm doing in China, for instance. And by the way, to answer your previous question, I have no problem buying KWeb down 80%. You know, buying a basket of it. I think that's the way to win as well. And I think he's got 70 or 80% of his fund converted into Hong Kong shares now, so the delisting risk is off the table. I think Brendan's a great manager, and I think that is a way to go. We just think there's you get a little more juice out of picking out of Alibaba in our view relative to a basket. But in the case of biotech, it makes perfect sense to buy a basket. What you have right now is 20% of the NASDAQ biotech index is trading at a discount to the cash on its balance sheet. So that's 20% of 371 companies. And just to give you an idea, this has happened, 4 other times. It happened in 2019, it happened in 2016, it happened in 2009, and it happened in 2002. And in every single instance off those lows, where you had a spike in companies trading at a discount to cash, you saw at least 100% rallies. And in the most recent one was 2016 to 2018, the XBI ETF corrected over 50%, just as we've seen in the last year. The XBI, a little over a year and 2 months, the XBI corrected over 50%. And the reason that the XBI has corrected this materially is largely fear over rate hikes. And it goes back to the cliches and the colloquialisms that people think they can't perform in a rising rate tightening environment with the strong dollar. And that was the exact environment we were in 2016. So it was a case of sell the rumor of tightening and buy the news. And what you'll see, if you go back, we actually put an article on hedgefundtips.com this week about this called Threading the Needle Stock Market, is that after that first hike or two in 2016, biotech bottomed down 50% and it took off. It was up 140% over the next 2 years, while the Fed funds rate was going from 25 basis points to 225 basis points. We're only at 75 right now. So we've done the first hike. We think we're getting at or near a bottom here with all this pessimism and washout happening and margin calls, et cetera. Probably a few funds blowing up and getting liquidated. And we think that we could see a similar type of situation in the rising rate environment, in the strong dollar environment, simply because you'll just have if for nothing else, you'll have the arbitrageurs coming in and buying these things at a discount to cash and forcing them to liquidate at par. And once people see that, the M&A game will be on. If you look at the pharmaceutical pipeline, you got $400 billion of cash in the Russell Healthcare Index, $400 billion of cash on the balance sheet, up 400% in the last 20 years. And the problem is they've got drugs rolling off their pipeline. They need innovation. They need it quickly. They need it desperately. So they have no innovation, but they have a lot of cash. What are they going to do? They're going to go buy that innovation. And all you need is one big splashy deal. The game will be back on. People will be panic buying these biotech companies. The big pharma will, in order so that they're not scooped up by their competitors. The game will be on. These things will be taken out at big premiums. And you'll be off to the races. And then you got the PDUFA coming in June. You start to see more of these drug approvals, and that's when you get the binary thing. So you're having a situation where you have the lowest multiples since 1986 in terms of price to book. Price to sales is the lowest in a decade. Price to book, you'd have to appreciate now close to 30% just to get back to your average multiple since 1986. Price to operating cash flow, you'd probably have to appreciate now about 160% to get to your average multiple since 1986. And price to forward earnings, you'd have to appreciate about 115% at these levels to get back to your average since 1986. And what we know, Marcel, is that things never revert back to their average. They overshoot on the downside due to emotion and despondency, and they overshoot to the upside based on euphoria and clear skies ahead. People, for some reason, it's perceived risk. People think they're riskier when they're lower and less riskier when the prices are higher, and they want to buy what's up. And that's when we'll help them out a year, 2 years, 3 years from now, when they're up 100, 150%, and everyone wants them, we'll help them out. Now that no one wants them, we're building our inventory, and when everyone wants it, we'll sell the inventory at high prices.
Yeah, buy low, sell high. Tom, I couldn't agree more on this. And these are awesome insights, but let me ask you maybe the final question, like what would change your views, for example, in the case of China, but also, let's say, what happens if the S&P 500 corrects further, or the NASDAQ? Do you think these picks can still rally, or what would change your views, or which are some indicators that are currently watching that you would say, okay, I have to take the loss here and bail it.
Yeah, so I would say the number one thing that I'm paying attention to is earnings. So if you look at the 2022 estimates and 2023 estimates in the last 8 weeks, they've gone up from 225 to over 230. While everyone's complaining about the economy slowing and we're going to get into a recession and et cetera, et cetera, et cetera, earnings continue to go up and the multiples continue to come down. So the average multiple for the S&P 500 last 5 years, 18.6 times. We're trading at less than 18 times forward. So we think that it's still attractive here. Now people say, no, but rates are rising. The multiple has to contract more. Well, the 10-year yield peaked out at 325 in June of 2018, and it peaked out at 303 in January of 2014. Those were the last two peaks. We're at, I don't know what we're at now, 307 today, 309. So I think we're getting close to, if not near a peak in yields. Once the rate of change has already slowed, but once that really starts to level off, I think people are going to stop worrying about exogenous events like the 10-year yield and inflation, et cetera. And as that starts to normalize off of high baseline effects from last year at this time, which hopefully we'll see in the CPI next week, I think people are going to get back to valuations and realize there's a lot of stuff that's still cheap. There's a lot of stuff that's down 90% that's still expensive. Stocks that have come down from 50 times sales to 30 times sales. You want to tell me that's a bottom? I'd say, how do you possibly know that? Because it has no earnings power, it has no cash flow, et cetera. So, we're coming off a period that the last 10 years, if you had said to me 15 years ago, you say, Tom, I've come into a lot of money. I have about $20 million. I'd like to lose it as fast as possible. Can you show me the way? I'd say, well, it's very, very, very simple, Marcel. All you need to do is buy a basket of stocks that are earning no money and trading at more than 10 times sales. And if you do that within 5 years, you'll lose 90% of your money. Good luck. And this last 10 years was the only time in history, if you go back 100 years, where you could buy a basket of stocks trading at 10 times sales, earning no money, and the price actually went up and actually outperformed the S&P 500. That regime is changing now with, money was free for a long period of time. Now there's a cost to capital. Once there's a cost to capital, people demand a return of capital, not only on capital, but of capital. And to do that, you have to have cash generative companies. We think Alibaba is a good example of that. And as it relates to biotech, with a large slug, 20% now trading at a discount to cash, with catalysts for binary outcomes in terms of revenue generation and earnings generation at these levels, we think it's attractive. So what would change our mind? I mean, nuclear war. So, there's always, we're in a game of probabilities, and I think that the odds favor a resolution in Russia more than a prolonged continuing of this process where no one's winning, everyone's losing money and lives, and there's no upside. So my sense is that's coming to a head, which no one's really positioned for. I mean, if you came in on Monday or Tuesday and there was some type of resolution or ceasefire in Russia, do you think being short would make a lot of sense? Yeah, and probably what you'd see on that type of thing, you'd see Alibaba would be up 15%. The biotech sector would be up 9 or 10%. Now, did anything change about Alibaba's business over the weekend that justified it increasing X billions of dollars overnight just because they ceasefire in Russia, Ukraine? The answer is no. They don't do a tremendous amount of business in Russia or the Ukraine, but it's emotional responses to these exogenous events that you just have to wade through. And on the one hand, you could say, well, this is crazy, it shouldn't be like this. On the other hand, you could say, this is an unbelievable opportunity, let's take advantage. So if you had energy stocks from 2020, so in 2020, we're in the middle of the pandemic, and I know you followed us for a while, we were pounding the table on banks and energy. Over the last 2 months, everyone wants to buy banks and energy that are up 200, 300, 400%. So what are you doing in this environment? If you're smart, you're saying, the war's probably not going to last forever. Maybe I take profits on my energy stocks that are up 2, 3, 400%, and I put them into the things that are out of favor, like China tech, biotech, et cetera. And then when they're up 200-300% a couple years out and everyone wants them and they're buying the quote unquote breakouts, we'll help them out and unload our inventory. And you just rinse and repeat over and over and over. But I think the margin of safety on these at these levels is so significant right now that what would change our mind? I mean, look, could Alibaba go to 50 tomorrow? Yes. Anything is possible, but, we'd probably be trying to figure out a way to peel off something that's working and add to more and take a long-term view. I think that flush to 75 was probably it, but you never say never. And, you try to have enough good things working that you can raise capital to take advantage if you get one more bite at the apple. And the same thing is true with biotech, in our humble opinion.
Thanks so much, Tom. This has been incredible. I don't want to take too much of your time right now, but I would really like to welcome you back on the channel and revisit this and see how it's been going. Thanks again for coming on. This was really insightful.
Thanks so much, Marcel. Appreciate being on.